Good afternoon, everyone. Thank you so much for joining us today. My name is Maria Asher, and I'm a co-portfolio manager on Westwood Select Equity and Dividend Select Strategies. Today, we wanted to take this opportunity to talk about the fixed income market, our outlook, and the opportunities we are seeing. For that, we have two perfectly suited colleagues joining us on the call as well. We have Scott Bernard, who's a PM and a vice president. He has a lot of experience covering traditional investment grade bonds. We also have Hussein Adatia, who is also a PM and a vice president, and he has a lot of experience covering more high yield distressed debt securities. Hi, Hussein, and hi, Scott. How are you doing?
Doing well, thank
Maria,
you.
thanks for having
Yeah.
us.
Of course. So let's get started. A lot to talk about, and thank you for joining us. Let's start with the fixed income market. It's been an interesting couple of years to say the least. So, for our listeners, do you mind recapping the market action this year and how does it compare versus last year when it comes to fixed income markets?
Yeah, certainly. The last couple years have been marked by the significant and dramatic shift in Federal Reserve interest rate policy. Following the pandemic in March of 2020, they cut interest rates to zero, kept them there for quite some time, and then in beginning of 2022, in March 2022, began this interest rate hiking cycle that took effect in 2022 and continued throughout the majority of 2023. So we have seen interest rates move higher across the curve, meaning from shorter maturity, which the Federal Reserve directly controls, to 5-year, 10-year, 30-year parts of the maturity curve. We've seen yields rise. So in 2023, we started the year just below 4% on the 10-year at 3.87%. We're now at 4.23. It's a slight increase that masks some of what we've seen throughout the year, where we saw the 10-year Treasury get up just to around 5% towards the end of October, before this latest month and a half, where we've had yields now decline pretty significantly, but still remain higher than where we were at the beginning of 2023.
And I would just add the two main questions that investors are trying to figure out right now is one, what is the terminal rate for the Fed? Most investors right now believe that we are at the terminal rate, meaning we will not have any more rate increases. There are certain investors out there that believe we could have more, especially if inflation proves to be stickier or if the U.S. economy continues to run hot. And the second question is, if we do start to get rate cuts, what is the ultimate neutral rate for the Fed? That means how low will they actually cut rates? Whether that number is 2%, 3%, or 4%, it's going to have broad implications for all risk assets going forward. And I think that answering that question will give you an idea of how assets are going to perform all over the world. But it's obviously a moving target. We have a lot of mixed data coming in right now, and so I think 2024 will be all about trying to triangulate where the Fed ultimately ends up when they do finish their cutting cycle, assuming they actually start it.
Thank you. That makes a lot of sense. So let's talk about the yield curve. As we all know, the yield curve has remained inverted for more than 12 months at this point. The inverted yield curve basically means that the long-term bonds are yielding less than the short-term bonds. Earlier this year, at one point, 2-year treasuries were more than 100 bips higher than 10-year treasuries. Over the last couple of months, we have seen this steepening of yield curve, meaning that the gap has narrowed. So are you encouraged by that steepening, and what is it telling us?
Yeah, I so typically when you talk about the inverted yield curve, it's often called a predictor of a recession. And the reason people use that phrase is because what it's reflecting is the expectation that at some point in the future, the Fed is going to be cutting interest rates. And likely they're doing that because there's some sort of economic slowdown, typically some sort of recession. So the market's getting ahead of the current pricing and trying to predict when that recession is coming. So to your point, it was around 100 basis points, the difference between the 2-year and the 10-year. We did see this start to increase really throughout the summer. Now the kind of unique part of what the two drivers of this, it came from higher 10-year yields, which is a little bit different than how we have typically seen this play out when it re-steepens. What we typically see is the front end moves lower, meaning the 2-year moves lower as opposed to the 10-year moving higher. So I guess it's encouraging in the sense that there's a lower probability on this expected recession, but it's not exactly giving an all clear signal to me yet, because it's still showing, elevated 10-year and elevated 2-year. It's not quite giving the all clear signal to me, at least as I see it.
Yeah, and I think the other part of the discussion about the yield curve being inverted that was missed is normally when the curve inverts, the recession that everyone expects generally happens several quarters after the inversion actually starts. And it's not an immediate recessionary signal. It takes time for the data to play, for whatever's happening in the economy to play through. The data has to reflect that, and then oftentimes, we find out when we're coming out of the recession, when the recession actually began. And so it's not a perfect signal. We obviously have had a lot of distortions over the last, call it 10 plus years, given what the Fed has done. But I think that where we are right now, I'm not certain that we're going to uninvert in the near term. But I think if the expectations for rate hikes really dissipate and cuts start to become even more priced in, I think you could return to a regime where you have more of a normalized type of yield curve.
Thank you. That makes a lot of sense. And I think I agree with you that it will be too soon to, give a all clear signal. That's still inverted. There are still some concerns around the economy and the growth. So let's dig deeper and talk about the Fed Reserve. As we know, and as Scott mentioned, that Fed had been on this aggressive rate hike path through July, and since then they have hold rates steady. We have an FOMC meeting starting tomorrow. So what do you think the Fed is going to decide tomorrow? And then more importantly, what kind of signals are they going to give?
Yeah, so we have a busy week ahead of us. We also have CPI tomorrow, and
Yes.
the Fed the very next day. I think this current meeting, we expect the Fed will announce no changes to its interest rate policy. Keeping the target rate at its current level of between 5.25% and 5.5%. I think that what they also will present tomorrow on Wednesday is a new, what they call, summary of economic projections, which is where each Federal Reserve member gives a forecast of where they expect the Fed funds rate to be at each coming year end. So year end 2024, year end 2025. And along with that, they will release some updated estimates of where they expect real GDP, core PCE, which is the Fed's favored measure of inflation, and the unemployment rate. So we'll get an update from the Fed members as opposed to their statement of where the economy is, along with where they think interest rates will be in the future. I think that is where we do have some possibility for the Fed to push back on some of these rate cuts that are currently being priced into the market. I think that while they might believe they are done hiking rates, I think they will be very hesitant to. They don't want to come out and directly tell the market that, because the market will often get ahead of itself and start pricing in even more rate cuts. So I think that Chairman Powell will likely spend some time at the press conference talking about that the Fed still, reserves the right to further increase interest rates if they need to, and that it's too early for them to start talking about rate cuts. Now, what the market actually hears as opposed to what Jerome Powell's saying is always interesting to follow. But I expect that they will push back a little bit on these rate cuts that have been priced into the market.
Yeah, for tomorrow and for this week, the market's pricing in a 99.8% chance that there's actually no change in interest rates, and so we can pretty much call that a lock. I think as we look forward into 2024, right now the market is pricing in 4 rate cuts, with the first one occurring sometime in late second quarter, whether it's May or June. My personal view is that it might be a little bit too optimistic, meaning I don't think that we necessarily are going to get the rate cuts that soon. And the reason why I say that is Chairman Powell has been, very clear throughout his whole tenure that he will be data dependent. And so I think if we get a couple of data points early on that show inflation slowing, that show unemployment rising, I think we're going to need to see even more evidence of that before Chairman Powell and the rest of the governors get comfortable with it. Because right now we have unemployment at 3.7%, GDP north of 5%. The economy is humming right now, and I think it's very, very optimistic to expect there to be rate cuts in the first quarter when the data still remains extremely strong.
Yeah, that makes a lot of sense. And I think, yeah, especially if you see the market action in November, the big rally that we saw was driven by these 4 rate cuts. But again, as you mentioned, that the Chairman Powell has been very clear that he's going to be data dependent. So we are going to need to see some true slowdown in the markets or in the economy before we, start pricing in or start realizing actual rate cuts. So let's dig deeper onto the fixed income markets and the opportunities that we are seeing. So within fixed income markets, if you think about corporates versus muni bonds, treasuries, and then high yield, which areas of the market are you finding most attractively priced at this point?
Great. So we've had some pretty big moves in the last 6 weeks or so that have shifted these relative values a little bit. But I think all in, we are still seeing attractive yields, meaning relatively high yields on virtually all portions of the fixed income market. The investment grade index is now yielding right around 5.5%. This is down from almost 6.5% in the middle of October. So it's been a pretty big move lower. Treasuries, as we've talked, are still north of 4% across the curve, from 4.75% on the 2-year to 4.27% on the 10-year. That spread between the two, what we call a corporate bond spread, or that yield differential, is the additional yield you earn for buying a corporate bond over a treasury. That has also compressed some. So we're finding that corporates are still, I still would favor corporates for a longer term investor, but I would also layer in some treasuries and for a tax exempt investor, that is. For a taxable investor, municipals do still offer reasonable value, but similar to corporate bonds, the yields there have fallen faster than they've fallen for treasuries. So on a tax equivalent basis, you are still earning extra for munis compared to treasuries, but not as much as you were, just six weeks ago. So I would favor some sort of balanced allocation between those two for a taxable investor as well.
Yeah, Mario, I think if you would have asked me this question 6 weeks ago in terms of what I liked in fixed income, I would have just said everything. We clearly got to a point where the risk was asymmetric to the upside. And then the rally that we've seen over the last month and a half has shown that. We had some investment grade bonds rally 15 to 16% in just a 1-month time frame, which is pretty incredible. You generally don't see those types of moves in investment grade bonds, especially absent some sort of a tail risk type event. I think now we're at a point where things are a little bit more normalized, if you will, but still very attractive. I like high yield bonds here. High yield bonds yield 8.25%. It's a very nice all-in yield. It's a good starting point, and it gives you a decent amount of a margin of safety if we do have an uptick in the default cycle going into 2024. With an 8.25% starting point, you can afford to have some losses in a broad high yield portfolio and still eke out a pretty strong return for the year. And that's assuming we don't have any declines in interest rates. So if you ask me to rank them right now, I would put high yield bonds at the top. I put investment grade corporate second, followed by munis and then treasuries. What would make me change my view right now? I think if we saw a market deceleration in the U.S. economy, I would probably want to be more defensive in my portfolio. But given where GDP is right now, given where unemployment is right now, I think we're going to have a relatively muted default cycle in 2024, and that that should push investors a little bit further out on the risk spectrum, and they should be comfortable taking a bit more credit risk in order to generate a higher return.
Thank you. That makes a lot of sense. And then just to follow up, because both of you run incredible strategies, but totally different, totally different focus. So how each of you are positioning your portfolios given the market, given the environment?
Yeah. So what we are doing in some of our portfolios is, throughout 2023, as yields were moving higher, we were increasing our what we call duration, which is a measure of how exposed you are to changes in interest rates. Meaning, the higher your portfolio duration is, if interest rates decline, your mark-to-market gains will be larger, or if interest rates increase, your mark-to-market losses will be larger. It's essentially similar to a beta, if you would think of it from an equity perspective. So we were increasing our duration throughout the summer and the fall, and as yields have had this pretty swift move lower, we have started to reduce that exposure a little bit. So reducing some of our duration, selling some of those corporate bonds, those investment grade bonds that Hussein was mentioning that have performed particularly well, and where valuations are just looking a little bit more stretched, or a little bit stretched. Not exactly to the point where we're concerned about wholesale losses, but just given that relative value, we are starting to reduce some of our corporate credit overweight in our portfolios that we run.
I think on the high yield side, I think the theme right now should be to move up a little bit in quality, given how much spreads have compressed this year. We are roughly at the point where spreads have been on an average basis over the last, call it 15 years. But I think it's important right now to move maybe out of triple C's and lower quality single B credits into higher single B and double B type names right now. I think there's a lot of opportunity in that market, especially on the new issue front. A lot of the borrowers in the single B universe borrowed during 2020 and 2021 during COVID, when rates were very low. And now many of those bonds are starting to mature at this point, and they need to be rolled over. And I think that's going to be a very fertile ground for us to play in. Just today, there's one large hospital chain that we're involved in. They're issuing first lien bonds. It's a single B credit. They have 8% bonds that are maturing, and they're having to pay 11% in order to refinance those bonds. There's no real credit risk at the moment. The company has plenty of runway. They're generating free cash flow. But given how the market has changed, they're just going to have to pay up now in order to refinance their bonds. And those are the opportunities that we want to be involved in. It's a healthy company with good management, a good outlook, a good balance sheet. But we want to be lending into those types of scenarios where we can pick up another 300 or 400 basis points in yield relative to where the prior bonds were pricing.
Thank you. And I think from what I'm hearing, there are definitely opportunities across the fixed income spectrum. And what we are doing for a lot of our clients on the private wealth side is that we are encouraging them to lock in that extend duration, as Scott mentioned, locking that higher rate, so that whenever we have a rate cut, you have lesser reinvestment risk and also get the price appreciation from having longer duration bonds. So let's shift our focus to something that is very important, because to us, obviously we approach everything from risk management point of view across our Westwood teams. So one thing that we actively monitor is the credit conditions. How concerned or how positive you are about the current credit environment. Obviously, during the regional banking crisis, we saw that shock to the credit markets, but then it looks like it was more of a company-specific problems rather than broad-based. But are you seeing any improvement in credit markets, or are you seeing anything that is concerning?
Yeah, Hussein's more up to date with some of the credit especially on the high yield, the smaller companies. But on the investment grade side, as I've mentioned, we've seen credit spreads tighten. So that credit spread is the market's kind of estimate of how much extra yield they're demanding to be compensated for that credit risk. So as that spread lowers and those yields compress, essentially the market's saying we aren't that concerned about credit risk at the moment. Now, as you said, following Silicon Valley Bank, we certainly saw, credit spreads widen. There was a little bit more perceived risk in the market. We haven't really seen that play out. The GDP growth as it continues, the economy is still doing quite well, and real economy is going to be a bigger driver of that than anything else. If there was a full-blown banking crisis, yes, the Fed stepped in and did what they needed to do to contain that to those few banks that were directly involved, and the spillover has been pretty minimal. Corporate issuers are actively issuing bonds in these markets, as Hussein mentioned, despite they're having to pay higher coupons than they were a few years ago. But there's plenty of demand from investors. Companies are able to roll over their debt, and so right now there aren't many direct concerns in the credit markets.
Yeah, I think there's a bit of a bifurcation going on. I think to Scott's point, the larger companies that are out there, that we see on our Bloomberg screen, whether they're investment grade or high yield, they generally all have access to the fixed income market. They're probably going to have to pay up for the pleasure at this point, but that's obviously better than not being able to roll over your debt. And so the large borrowers that we generally follow, I think are generally they're hanging in. They're doing well. They're seeing some top line growth because of the inflation that's out there. There's not a lot of real concern for that subsegment. I think where you're really seeing a little bit more stress is for the smaller and medium-sized businesses, call them Main Street, if you will. These are the companies that rely on their local credit union, rely on their local regional bank in order to take out a mortgage, finance equipment, finance receivables. And we've seen a pullback from a lot of those lenders in the wake of Silicon Valley Bank. And I think that ultimately what it all means is that at some point the rate hikes are going to start to bite. We're going to start to see less capital going towards growth capex, less capital going towards hiring, and more capital is going to have to be spent to service debt in the real economy. So ultimately, when that happens, I'm not sure, but it's going to continue to be a drag and slow the economy down, which is exactly what the Fed wants.
Thank you. That makes sense. Super helpful. So my last question is about something that is very important to our clients, and it is about the growing U.S. debt. Earlier this year, we saw a couple of agencies downgrade or put U.S. credit rating on watch. How concerned are you about the near-term impacts, if any, of the U.S. debt downgrade?
It's not an immediate concern of mine. It's certainly the trend towards higher debt is seemingly never ending, and the downgrade from Fitch, it did coincide with a move higher in bond yields. Now, the other thing that came out around that exact same time was some announcements from the U.S. Treasury regarding how many bonds they were going to have to be issuing. And that came out at around the same time, and those numbers were higher than people had expected. So there's more Treasury, more supply of bonds, and this really corresponded as well with the move higher in yield. So it's hard to always pinpoint exactly what's driving things, but it's a global investment. Fixed income is a global investment, and the United States is not the only country that's issuing more debt, raising more, issuing more into the fixed income markets. And so it's kind of a race to the bottom in some ways. And the United States, while it's down, there has been a debt downgrade. I think France was recently downgraded. Other big Western European countries are facing similar issues. So it's not something I want to completely gloss over, but it's also not the biggest near-term concern to me.
Yeah, I think practically speaking right now, it has very little, if any, impact on what we're doing day to day. However, I think in the longer term, our fiscal position is clearly unsustainable. $1 trillion, $1.5 trillion deficits, as far as the eye can see. At some point, we're going to have to pay the piper, and that's going to occur, through a variety of different ways. Whether it means taxes are going up, whether it means entitlements are coming down, who knows? So far, no politician has been brave enough to actually, put forth a plan and vote on it and really try to push it through. I I don't know if we'll have anyone that's willing to do it until we actually get to the point where it looks like it's going to break something in the U.S. economy. So yeah, I think longer term, it's definitely going to be an issue that needs to be dealt with. For now, though, the U.S. remains the best house in a bad neighborhood. It's not a great answer, but we benefit from being the reserve currency, and 95% of investors out there would probably prefer to own the U.S. dollar over anything else right now.
Yeah, I think I agree with both of you. While obviously that the growing debt is not sustainable, it's not something that we expect them to have an impact right away on any kind on either equity or the fixed income market. But I do agree that both Republicans and Democrats will have to come together and find reforms, find common sense solutions so that they can eventually be answered. Um, these are all the questions I had. Thank you so much, Scott and Hussein, for your insights. I'm sure everybody on the call found them insightful and helpful. And thank you, everybody, for joining us on the call. If you have any questions, please feel free to reach out to your advisor. And from all of us at Westwood, we wish you a very happy holidays. Thank you.
Thank you.
Thank you.